Good morning, everybody. Looking at our stream here, just making sure everything's live where it should be, making sure I've got my audio playing. Bear with me one moment. Let's make sure that audio is on. So I did have some issues last time. Let's see here. Testing, testing. But I do not think you guys can hear me here. One moment. Let's see here. Audio. Oh, no, you guys can hear me. Perfect. All right, cool. Hey, welcome to Office Hours. Sometimes we put this out there to the YouTube and a couple different places. So if you're seeing this, we also have Office Hours for our members every Friday. You may see this in some YouTube channels as well. Today we're going to talk a bit about a presentation we're putting together on commercial real estate. And specifically, we're talking about investing and stacking returns. So we're going to talk a little bit about the basics of commercial real estate and how it's analyzed and how it's reviewed, and specifically kind of focus a little bit more on retail, but we're going to look at how to review and look at commercial properties. And then we're going to look a little bit at multifamily. We're going to take a quick look at multifamily. This is going to be a bit of a two-part presentation where we'll dive deep into the stacking returns and how multifamily owners tend to, especially the mom and pop, kind of smaller multifamily owners, what we tend to see is we're not looking at the full picture on cash flow, and we're also not looking at the full picture on where we should look at with the expenses, right? We might have more in there than we realize, and there's a lot of things we probably should pull out of there, and there's also some things with the expenses that we should probably put in, and the income piece is not what we tend to think of in multifamily. So we'll jump into that. If you have any questions, go ahead and type them in the comments. I should be able to see that across all the platforms. We're going to go ahead and get started here on investing in commercial real estate. We're going to talk a little bit about what commercial real estate is, different product types, subtypes. We're going to build a little foundation here. So we're going to talk about what commercial real estate is. We're going to talk about the lease types in commercial real estate. That includes apartments and multifamily, how to value commercial real estate assets, and then how you should probably reposition those assets, right? And how to do that across the asset types. We're going to use retail as a bit of an example, but you're going to see how we can reposition both the paperwork on your properties, including with multifamily, and then the physical changes that you can do as well to adjust the cash flow as well as your tax flow and your time flow as well. Don't see any comments just yet. Go ahead and ask any questions as they pop up. Okay, so the basic, we call them basic food groups for commercial real estate. I'm going to go very basic here. There's much more, but just to go bare bones, there's multifamily, you got retail, industrial, office, agriculture, and land. These are all very different in their own respects. There's different things you look at, terms, lease types that are common, etc. There's also others, right? Hospitality, self-storage, mixed use would be some examples. Okay, so depending on what you're looking at, there's different terms, there's different things to look at for each and every one of these things, right? Just to use retail as an example, right? So retail property type is one. There's also lots and lots of subcategories. There's on a large center, there's mall, lifestyle center, outlets. So that would be a retail property type. You got a power center or a community center. These would be somewhat large still, but these have what we call big box stores, right? So you got your maybe like a big center that has like a blanking now on big box stores, Home Depot, as an anchor, and then some big retailers, um, that along the sides there. You see them like 4 or 5 of them that take up a huge parking lot. Neighborhood center would be more like you've got a grocery store and then some inline spaces, which are those stores along the side of the grocery store. And then your convenience and strip malls, you see those all over the place. 4 or 5 different little tenants in there. You've got the laundromat, the nail salon, that kind of thing. You have freestanding buildings. You've got mixed use where you mix in office or multifamily with the retail. And you've got things like movie theaters and other specialty retail. So those are all retail property types, right? And that's just with retail. So as you dive into the different commercial property types, they're going to be very different depending on what you look at. And we're going to use retail as an example. Now, leases as well. Remember, we're building a bit of a foundation here. Okay. Up at the top, you've got full service gross lease, a gross, modified gross, net, double net, triple net, and absolute triple net. I will tell you that these things all bleed together a little bit. It really depends on what's on the 4 corners of the contract or the lease. That's what matters. Multifamily, you're probably very familiar. Most people are pretty familiar with what a lease looks like. On the commercial side, as you get into commercial tenants, excuse me, what is on the 4 corners of that lease is exactly what matters the most. I'll give you some examples of each of these. Now, up at the top here, you see here's a little meter. How much of the expenses are covered by the tenant? Okay, and as we go down, it's gonna end up those tenant types, those lease types at the bottom are going to be where the tenants have more and more on them. Now, that could be passed through, where the owner pays for it and then the tenant reimburses them, or it could be paid directly by the tenant. With a full service gross, the tenant's going to pay a flat fee, and that's pretty much it. They typically will not pay janitorial or electric or even internet. This could be something where you've got an office and you've got a spare private office perhaps, and you have someone come in and pay some money to use that. That would be a full service gross lease where they're just kind of basically a sublease, paying you a fee to use the space. Okay? Nothing else. Gross lease would be a little bit more. So you've got essentially the same situation where you pay a flat fee, but you don't really have anything else. But you may pay janitorial, you may pay your own internet. Some very basic things are moved onto the tenant. Modified gross is what you typically see in multifamily. That's actually called a modified gross lease, and that's where they pay you a base rent, right? But they're also handling for their unit several expenses, right? Same thing in retail strip centers. The tenant is probably paying for their electric, right? They're paying for their internet. They've probably got insurance or renter's insurance, right? And I would think on these other two that you're going to want to ask for that, but it's more common in these where we're really asking for insurance. You've also in retail, you may have them paying for things like trash, reimbursing for trash, right? And you see that in apartments where it's called RUBS, ratio utility billing system, where they're reimbursing for some sort of utility cost, right? Industrial gross lease falls here. That's a little bit different because there's a lot less that goes on as far as ownership is concerned. In an industrial building, the tenants handle a lot on their own. But retail, an office, the tenants tend to need a little bit more attention. Net lease is where we're moving in even more stuff onto the tenant. So now we're starting to pay things like CAM or common area maintenance and net fees. So the tenants are now starting to reimburse the owner on these types of leases, on a net lease, for some of their, or ideally all of their operational expenses. Okay, so CAM fees, common area maintenance fees, could be landscaping and janitorial. It could be maintaining the exterior of the building. It could be the exterior lights of the parking lot. Those need to be paid. That's common area maintenance and net fees would be more along the lines of like taxes and insurance to be reimbursed to the owner. Those could be some net fees falling under there as well. Now, double net is a little bit farther along. Double net and triple net absolute tend to kind of bleed together. Someone will tell you it's a double net or a triple net, and mean it's an absolute triple net. You're going to want to start asking more questions as you get over to here. Key things I have here, considerations as you get down to the net lease stuff, the roof and structure, who maintains that, HVAC systems, who is maintaining it, and is there a maintenance contract that has to be in place, right? Sometimes it'll say the tenant's going to maintain the systems or whatever, but owner's responsible for all underground improvements, all the sewer and water, that kind of stuff, subfloor stuff. The owner's on. So pay attention to who pays what, and is it reimbursed or is it paid directly, right? So sometimes, like your triple nets and your absolute nets, this is essentially where the tenant pays you a flat fee and tenant handles everything else. Now, on these, a lot of times with the double net and the triple net, these are going to be standalone, single tenant, or only 2 tenant buildings where there's not a lot of moving parts calculating who pays what for CAM fees. But there also needs to be a consideration when you look at these on who pays the taxes and the building insurance, and is it reimbursed, right? So is it we're going to pay the owner for the taxes that come due, or are we paying them directly? Okay, because that is an extra step that could mean that the owner has to do something, right? And it's not uncommon for there to be, especially on a standalone lease, or with just two tenants, to have some sort of management fee reimbursement allocated as well. Now, there's not a lot of management that needs to go on with these, so sometimes an owner might say, yes, I'll take that 5% or 10% of the needing to manage things, and you can pay that to me directly as an additional income because I'm managing it myself. There could be within the lease, the owner has to or can charge a management fee to the tenant to be reimbursed to them. That's possible too. Okay. I'm trying to think. I think that's it for these. Those are the major leases there. There are some terms you're going to want to know in commercial, right? Base year rent stop, expense stop, CAM and net fees we talked about, TI allowance, tenant improvement allowance. If I have an office tenant come in, they're not necessarily going to like the layout of the office. They might want things moved around a bit, right? I did a lease with a R&D company where they needed a clean room, right? And they needed a big IT tech room, right? And so there were some adjustments that had to be made to the space, and there's an allowance that the owner will consider. And that calculation is done between the owner and the broker. A lot of times the broker will help you determine, do I release the space to the current tenant with a lower TI allowance or no TI allowance, or do I try and find a new tenant and have to spend a TI allowance to get them? Because oftentimes if a tenant's been in there for a while, their rent is likely well below market. So that's a consideration. What is it worth it to me as an owner to trade the tenant out? Load factor as well, and percentage rent. Percentage rent would be a percentage of sales. So if the sales exceed a certain amount, then I get a certain percent of an excess of that amount. Example is the percentage rent kicks in above $1 million, in sales, and then so I've got sales reporting, and then the sales come in, and then they've sold $1.2 million. I get a percent of the 200,000 that they are in excess of $1 million, right? That's within the lease. So these are all these things that you're going to be looking at in the lease. Now, when we're looking at we're looking at commercial properties, there's going to be a consideration where you have to look at, it's not just increasing the income to increase the equity, right? We all know that you're looking at a cap rate. Let me see if I've got this here. Yeah. So we all know we're looking at a cap rate when we're looking at an investment property, right? Because an investor is going to be buying an investment, an income stream, right? And the quality and stability of that income stream affects how much return I'm going to expect for that. How much time am I going to be spending on this property? How much risk am I taking on? And if that answer is not a lot of time and not a lot of risk, I'm willing to accept a lower return for that, right? So that same one, I use $100,000 in net income. That same $100,000 could be more or less to the purchase price, right? So when I look at a building and I look at repositioning a building, I'm looking at, can I increase the tenant quality? Can I increase the length of leases? There's some things I can't change. I can't change the location. I can't change the market. But what I can consider when I'm acquiring a building is, what are the risk factors with the market? Is there going to be a road that comes in and takes all the traffic away from my building, right? These are things that you can consider, but there's things that you can change within the building that will adjust the return based on that same net income. So very basically, yeah, price. Now we can move back and forth these things, right? So the cap rate calculation, if we know any two of these things, we can find the third. So price times return is the net income. Net income divided by return equals price. Now here's the thing. I always tend to think of the net income. Can I get that number up? Because that's going to affect the price, right? Net income can be changed, but guess what? The return, the acceptable return, can also be changed if we change the quality of that income stream. If we change the stability of that income stream, that same $100,000 will be calculated differently. So assume we've optimized things with our investment and we're getting $100,000. Now, in one case, it might be a riskier $100,000. Maybe the lease terms are a bit shorter. Maybe the quality and stability of those in different ways are less. So I'm going to, in one case, an acceptable return would be a 5.5% cap rate, right? But let's assume I still am optimizing my income, but now I've optimized it and it's a little bit more stable. The quality is a little bit better. And one of the considerations that you can have, and we're dealing with this right now with one of the escrows that I'm in, are all of the leases on the same form, right? A lot of times you'll see a mom and pop that have all kinds of different leases mishmashed together. And if you can paint a clearer picture for the investor when you go to sell it, with clean leases all on the same form, you clearly have identified, here's your increases, here's the CAM fees, here's the net fees, here's your base rent. A lot of times, especially with retail, all of this is mushed together into basically a gross lease or a modified gross lease when they should be on net leases. So if I'm in this investment that's producing $100,000 in net income, I can very easily adjust and just get everyone on the same form of lease, where now the lease is clear. I've separated out the base income. I've separated out the CAM fees and the net fees. To the tenant, perhaps the total rent going out is exactly the same. But when an investor comes and looks at it, the base rent, like if I've got, let's say $10,000 in rent coming in, and it was on a mishmash of leases, I go to the tenant who's paying $10,000. I say, look, your rent's going to be exactly the same. We're going to get a new clear lease together. Your base rent is going to be $8,000. And then the net fees, these are the common area maintenance, the landscaping, everything, that's going to be $2,000. So your total to me is exactly the same, Mr. Tenant. But this is going to be a little bit clearer to me and to my investors on exactly how that's split up, right? Tenant doesn't necessarily care. But when I, as an investor, go to look at that, now I see, okay, here's what they're collecting in net fees, right? And is that at market or not? Probably going to be at market when I set that lease. But that $8,000 that the tenant's now paying in base rent, perhaps me as an investor, I can now look at that and say, whoa, the 8,000 is actually below market. That's interesting, right? But now I've got a clearer picture. So now me as an investor, I'm number one looking at this and saying, oh, wow, the rent's below market actually. And number two, I'm probably willing to accept a lower return, i.e. investment number one, because I now have less perceived risk because I've got a lot more clarity on how things are set up with that building, right? So that's an example of how you as an investor can go in. You can look at the leases. You can say, oh, he's not collecting CAM or net fees, so let's just separate those out. And just on paper, with this example, you're making close to $200,000 more because someone's willing to change that cap rate number. You didn't change the net income number. You changed the cap rate number. You're willing to accept a lower return. You just made $200,000 just by cleaning up the leases, right? So that's important. You can change the net income when you look at a property. This can go for multifamily too. But it's really effective in retail and office and industrial when we can split out and clean up the leases, right? So I want to talk a bit about some mistakes. Let's see where we put these. Yeah. So we can talk about two different things here, right? So we optimize the net income. I'm going to largely assume that you've done that, but we're going to go over some examples here on how to do that with commercial, right? I gave you one example about cleaning up the paperwork. Here's kind of how we do that too, right? These are very common mistakes that a lot of commercial owners make. I'm going to look here. I don't see any comments or questions yet. Again, guys, if you have any questions or comments, just let me know. That's the whole point of this every Friday for our members who are listening. We do this so you can learn, and then we do this so you can ask questions, right? So with and specifically with retail, they don't collect CAM or net fees, okay? Or it's not clear. And they're not calculating the net fees. A lot of times I'll see a retail building where the tenant says, yeah, here's your base rent, and then the net fees or the CAM fee is $50, and it's a set $50. That's part of the lease, right? Well, you're not really collecting net fees. You're just collecting an extra $50 on paper. They should be calculated every single year, right? So my expenses, my landscaping costs, my maintenance costs, my utilities, those are all going up. Right. So in retail, when we're calculating these things, we need to do that every year. I'll show you how that works. But a lot of times people aren't doing that. A lot of times they're not separating out the CAM and net fees from the base rent. And so they're, number one, you look at the rent per foot and it's below market, but then you also figure out, oh, they're also not collecting their net fees like they should. So that dollar per foot rent is way lower in actuality than it is on paper. So it's even more below market. So we need to make sure we're doing that and calculating net fees. We need to make sure we're enforcing any increases properly. Many times I see, and with one of the escrows I'm dealing with right now, tenant has an annual increase. They're just not collecting it. Tenant had an increase set for the beginning of this year on one of mine. They didn't increase the rent. Tenant didn't say anything. They're still collecting, I think, $150 less than they should be collecting every month from one tenant. That's just one example. So cleaning all this up, you can see if you acquire some commercial property and you know that you can just clean things up, that'll go a long way. And then we're going to talk about load factor. Load factor is huge, especially in office. Okay. So net fees, let's talk a bit about what those are real quick. And then I'll show you how to collect them and how to calculate for them going forward, right? So net fee is going to be identified in the lease. So if you've got multi-tenants, you probably know exactly where that is in the lease. But in a commercial lease, all of the different aspects of cost are going to be identified, like who pays the taxes, who pays the insurance, what the insurance needs to be. who pays what utilities when, who owns and maintains the HVAC, roof and structure. All of this is figured out in the lease. So go to your lease, figure out who pays what when. Is it reimbursed? Is it paid directly? And then you can calculate what kind of cost you as an owner are incurring, right? So common area maintenance is going to include trash, house electric, janitorial, landscaping, general maintenance, right? Sometimes even, I mean, you can throw in a capital expense budget. That's a whole nother conversation. How owners, hey, you replaced 2 HVAC units last year. That cost you whatever, $20,000, $10,000, $20,000. Why is that in your expenses when you're trying to sell, right? That $20,000 is like hundreds of thousands of dollars in equity that you're just throwing away, because your capital expenses should not be in your profit and loss when you go to sell, right? And the broker will pull those out. But if you, as an investor, are looking at another investment, make sure you note that, right? Sorry. So the camp fees, and then net fees would be like building insurance, property taxes, stuff like that. And I said before, management fees, those can be thrown in there too. Depends on the lease, right? So let's talk about how to calculate these, right? You've got a base rent, right? And you calculate that by foot. So I like to go by month, right? So some people will calculate by year. I calculate by month. So the rent per foot per month is $1. The usable square feet, we'll talk about usable versus rentable. That is 2250. Base rent would be 2250, right? Cool. Well, also the net fees, right? So I've got $1,000 in my net fees every month. That's costing me, my maintenance, my taxes, my insurance, all that stuff. Everything I'm charging to the tenant based on their lease, $1,000. Now my building is 5,000 square feet. So the fee per foot is 20 cents. Right? Easy calculation right there. Now, the tenant's not going to be paying for the whole building. They're going to be paying for their usable square feet, what they personally have as their unit. Okay. So to calculate for this tenant, we're just going to multiply the square foot by how much the net fees are. You see that right there. 2250 square feet by 20 cents is $450. Now, the total rent due from this tenant is $2,700. And what I told you is people are not collecting or calculating net fees. So you can see here, likely an owner may be missing some or all of those $450 from this tenant. Okay. Now we're going to talk a little bit about how to adjust that annually, right? So you fixed it on the base year. It's called a base year. So first year. Okay. You'll estimate, hey, you're signing the lease here. Our estimate for this year is 20 cents a foot. At the end of the year, we'll reassess, right? So here's how that works. You're going to take last year's net fees. So right now is 2024. I would take the total net fees that I incurred that are normally reimbursed for 2023. I will adjust my going forward for 2024 based on those numbers, right? So I've just got 2 tenants in my example building. My net fees are $450 a month. I think I calculated that right for 2 tenants, right? Let's see. Did we calculate that right? No, we might have calculated that wrong. Okay. Well, this is just to show you an example. Let's say the total collected for the building was 10.8. The actual cost for last year was 11. That means the tenants will owe me their portion of the overage, right? So I only collected 10.8. I'm still owed $200 for last year. So don't let that go. You will go to the tenant the first of the year, say, here's how I broke down my expenses. It was actually 11. It wasn't 10.8. So here's a bill for 200. You can pay that now or over the course of the year, whichever. Yeah, it depends on the situation. But Also, going forward, we're gonna assume this year that the expenses are probably going to be 11,000. So your new net fee to me is X. Your total now rent due every month, depending on how we want to collect that overage, that $200, is Y. And then off we go, right? So you should be doing that every year. Most people don't do that at all. Okay. Now, we also talked about load factor. No one collects the rent for their whole building, but they should. There's a difference between usable square feet and rentable square feet. And guess what? Most owners are not collecting any rent for this space. Now, it's particularly a problem in office space because there is a lot of common area in an office. But you could have a retail building with a common area courtyard, like an amenity like that. Or rentable, an interior space, but basically like a lounge area or something like for people to relax at. It's like a gated area for having food or something. If someone's not paying for that directly, like a tenant's not collecting, paying rent for that patio area, in my example in retail, you're losing money. Okay, so here's a calculation based on it. We still have our 5,000 square foot building. Each tenant, there's 2 tenants in here, right? Each tenant has a 2,250 square foot unit. That's their usable is basically your unit, right? So your private office space, your private unit space, your nail salon. That's your usable space. Now, there's 500 feet left over, right? That neither tenant has as their private space. What is that? That is the common area, right? Now, if we divide 500 into our total building size, that's a 10%. That's how you calculate load factor, the common area divided into the total building space or rentable square feet. That means 10% of this thing is common area, and I've got a 10% load factor. If I'm not collecting rent for all of those square feet, I'm missing out on 10% of my rent every month, right? So when you bring a tenant in, this is when we address this and the net fees. We address all of this when we lease it up. A good property manager will do so. Here's just one example of why you should pay for a property manager, right? You're thinking, well, I can do it all myself. This is a good example why you should probably have a property manager. Okay. So that's really all I wanted to cover for now. We can go into stacking returns here as a second consideration. I'm going to go a little bit into it. We've got 10:33 my time. I'm going to give it maybe a couple minutes, see if there's any questions that pop up. If not, we'll shut her down. We'll see you next week. Let me know what we want to talk about. But let's talk a little bit about stacking returns. Okay. So let's see here. Yeah. So I see everyone focused on cash flow. And this is what we'll talk about next time, actually. Everyone's focused on cash flow. So you've got your debt service. Okay, I've got my expenses. My net income then turns into the cash I get to put in my pocket, right? That gets taxed. You don't think about your tax flow or your time flow. And even with cash flow, a lot of owners don't think about everything they should, right? Here's just a very brief example. And we'll just go over cash flow real quick. And then next time we'll go over time flow and tax flow. Because guess what? As you get older, the amount of time that you have where you have to focus on your investment as opposed to your investment running on its own and you get to spend time with your family, that becomes a much more valuable time. Okay. It's worth a lot more to you than as you get younger. So that is a very, very real consideration is how much time do you spend in your building? So let's just talk a little bit about cash flow. So this person bought it for $1 million. Current net income's $100,000. They've held it for 15 years. Well, that's what they think, right? Or that's what that actually is. So what they think, though, is they don't really, when you get a profit and loss from a mom and pop, you don't really realize that there is, maybe they're managing it themselves. the building insurance and their taxes are typically not on the their accounting operational profit and loss. Usually that's not even on there. So when I talk to an owner, especially multifamily owner, they said, well, yeah, my profit and loss, yeah, so here it is. And you can see here my total, you can see they're uncalculated. My total expenses per year are $20,000. And then I look at it as, okay, he's kind of maintaining it himself. And they're also managing it themselves. There's no management fee on here. Also, usually the insurance and the taxes aren't on there. Right? It's a profit and loss for the operations of the building. So if it's a small, 15, 20 unit building, sometimes these aren't even on it. They're not even thinking about it. So if you look over on the left there, the perceived net income, they say, yeah, my gross rent's 175. I only have $5,000 in vacancy because I don't raise the rents because I don't want the vacancy. Well, okay, you're hurting yourself. But yeah, cool. Your vacancy is very low. So yeah, my expenses, my net income is 155, and I bought it for $1 million. I'm killing it. That's a 15% return. Well, no, your actual expenses, you have property taxes, you have the insurance. Are you maintaining it yourself? Yes. Okay. Well, let's throw a little. That time is valuable, so that is worth about $10,000. Maintenance as well, you need to have someone else doing all of that. You shouldn't be doing that. So the actual expenses are closer to about 70,000. So your actual net income there is about 100,000, right? So and they're like, oh, still $100,000 on $1 million purchase, pretty good, right? Now I'll show you why that's not so good, actually. Number one, your market rents. You're hurting yourself by not raising your rents. The market rent is probably closer to 250. And yes, you will have more vacancy, but guess what? Your net income is going to probably actually be 155 if you were to raise your rents to where they should be and have the expenses where they should be. But I digress. Let's go back to this. Let's just talk, and we're just talking about equity right here, right now. We're not talking about tax flow. We're not talking about the time flow. They bought it for $1 million. Their current net income, now that we've shown them, is probably about $100,000. They're thinking in their head that their return is 10%, right? 10% of $1 million is $100,000. So they're thinking they're doing great. Well, in reality, they've had it for 15 years. They might have bought it for $1 million. It's worth $5 million right now. So if you divide $100,000 into 5 million, guess what? Your return's actually 2%. Now, my question is, how can I redeploy your equity, right? Your $5 million property. How can I redeploy that, right? And the answer I often give them is, hey, put it in. I like fast food, so put it in a Burger King, right? You're not the Burger King owner. You don't flip burgers. You don't run employees. Burger King is your tenant. Burger King is on a 20-year lease that increases annually. Burger King pays everything. Remember, we were talking about the different lease types, right? So if I'm dealing with multifamily, we move off of their plate all of the things they have to do, right? You don't have to do tenants and toilets and trouble anymore. What you now have to do is collect, rent checks from Burger King, a franchisee who's worth $40, $50 million for the next 20 years, and figure out what to do with all your free time. That's what you have to do. Because guess what? When I redeploy that $5 million property, that's not worth $1 million. It's worth $5 million now. The net income that I can get you is a lot more than $100,000. So I'm going to get rid of all of the things that you have to do to maintain your property. I'm going to bring you over to a new property where now it's better guaranteed. Your net income is not $100,000 anymore. Now it's $200,000 or more, right? So 5% return on 5 million, which is right now it's kind of the floor, would be about 250. So that's how I get a lot of my listings. Is I'll go to them, and we don't even talk about tax flow or time flow. A lot of times, the taxes, the depreciation is all wiped out. So you need to buy up. You need to get a loan on this thing. That's a whole nother conversation. So we'll do a part 2 of this. Again, that's how I'm getting my listings. If you have an interest in this, feel free to go to, I think it's up right now, apartmentequityreport.com. If you want to check your property's equity, go ahead and go to the apartment equity report. And it should take you about 5 minutes or less. You throw in your expenses, you throw in your rent roll, and it'll spit out. Now, a broker on the other side will take a look and double check it, but it spits out a valuation of your property. You can see how you stack up against the market. Hopefully this helps. I don't see any questions right now. Just double check here. I do not. All right. Hey, guys, I'll give it a minute. I'm going to get another cup of coffee here. If you have any questions, let me know. Otherwise, we will shut this down. We'll see you next week with part 2 of stacking returns. Be right back. All right, I am seeing no questions, guys. Otherwise, if you have any questions, please throw them in the comments below because I am going to head out here and we will see you next week for part 2 of stacking returns. Have a good week.